it's important to start getting familiar with these definitions because we build on these things later in the video series. And the Forex markets organized sheet, we have the breakdown in the presentation. So if you just download it, you can familiarize yourself with it in your own time. So back to this point, what's more important is that we need to start looking and understanding how we capture and segment volatility rather than segmenting by geography and size of transactions. Floating and pegged regimes and commodity dependency is the main way we do it. And what you've got to start thinking about is how countries, the value of their currency, how a country's value of currency depends on factors outside the country itself. So the phrase we use here is exogenous factors. So exogenous factors are factors that affect the value of a currency, but they are outside the control of central authorities within the country. So for example, if you're a country that depends very heavily on one trading partner on the other side of the world, but that trading partner has a difficult time in their economy, that is going to have an effect on your currency as a country, whether you like it or not. It's an exogenous or exogenous factor that is affecting the value of your currency. It's out of your control. Now, these are very important to professional traders because this is one of the drivers of volatility. And that's why we segment by commodity and by regime. Now, we've put the results here of our breakdown from the Forex markets organized sheet. And the first thing we look at is the ex-commodity floating currencies. And what we find is we break down, first of all, by developed float. So what do we mean by that? We mean developed economies that have floating regimes that are not dependent on commodities. Then we have the EMEA floating currencies that are ex-commodity, the Asia Pacific floating that are ex-commodity, and the LATAM. And you can see there's no Latin America there. The next definition is the ex-commodity pegged regimes. So we have Denmark in here. Denmark's not in the G10, but it's a developed nation and is an important trading partner of many European nations. So we've included it in the analysis. So developed ex-commodity pegged, the Danish kroner, which is pegged to the euro. We also have Asia ex-commodity pegged. And we have in Asia the Hong Kong dollar, which is pegged to the US dollar, and the Sing dollar, which is pegged to a basket of currencies that are not made public in terms of the weightings and the exact sizes of those weightings relative to their trading partners. In the Forex markets, commodity floating, so we're talking about floating regimes that have commodity exposure. We have our four that we looked at earlier that are part of the G10, but we don't call them G10, we call them developed commodity float. We have our EMEA commodity float, our Asia commodity float, and Latin America commodity float. So all of these are floating regimes that have significant exposure in their exports to one or two commodities. And then the next part of our opportunity set, the commodity pegged, we break down as EMEA and Asia. So EMEA commodity pegged and Asia commodity pegged. And we have here in EMEA all of the GCC countries, and the only Asian currency that has significant exposure to commodities and is pegged is the Chinese yuan. And we have the question mark here next to the Chinese yuan, similar to the question mark next to the Sing dollar. Why is that? Well, it's because the way in which the currency is pegged is not fully 100% aware or understandable. So, for example, with the Singapore dollar, there is a basket of currencies that the Singapore dollar is weighted towards. We don't 100% know what those currencies are, and we don't 100% know what the weightings are. And that is essentially to stop speculation on the currency. The Chinese yuan is pegged against the US dollar, but it's what we call a crawling peg, in which it's not exactly fixed at a particular rate. The rate changes, so it's questionable. Again, we'll look into these things properly in video number 2, but for now, we just need to get this principle down, which is we have to start segmenting and defining currencies based on their opportunities and risk, i.e. their volatility. And by doing so, we create our opportunity set. The opportunity set is essentially working out where the opportunities lie to make money as traders.